Good evening. What you are seeing on your screen right now is not a mistake. It is the worst crash in 43 years. Gold down 9% in a single day, silver cut in half. While the headlines are screaming market collapse, there is a hidden story they aren't telling you. The same institutions that triggered this panic are the ones quietly buying up every ounce of physical metal at these fire sale prices. Is this a crash, or is it a calculated transfer of wealth? In the next few minutes, we are going to expose the 48-hour ultimatum, the Federal Reserve's hidden trap, and why the whales want you to panic sell right now. This is the truth behind the hidden economy. Our lead story tonight follows a historic and staggering collapse in the global precious metals markets that has left investors reeling and analysts scouring the record books for a comparison. In a single trading session, gold has plummeted by 9%, marking its most severe weekly decline since 1983. This rapid erosion of value represents the shattering of 43 years of market history in a mere 5-day trading window. Silver has fared even worse, currently trading at 61 after being effectively cut in half from its January highs. As digital tickers across the globe flash red and financial headlines scream of a terminal market crash, a deeper investigation into the underlying mechanics suggests a narrative far more complex than a simple loss of value. While retail portfolios are being liquidated at an alarming rate, data indicates that the very institutional entities responsible for triggering this downward spiral are the same organizations quietly moving to accumulate physical metal at these depressed price points. What is being characterized by the mainstream press as a catastrophic accident appears, upon closer inspection, to be a calculated strategy. We are witnessing the largest fire sale in 4 decades, and tonight we will break down exactly how this hidden economy operates and why the current carnage may not be what it seems for those who hold physical assets. To understand the sheer scale of this volatility, we must first look at the unique confluence of events that triggered this market carnage. It was not a single factor, but rather a perfect storm of 3 simultaneous pressures that created the worst crash in 43 years. The primary catalyst for the initial wave of panic was a geopolitical development of unprecedented gravity, the 48-hour ultimatum. President Trump issued a direct demand to Iran, giving the nation 48 hours to reopen the Strait of Hormuz or face targeted military strikes on their domestic power plants. It is critical to note the specific nature of this threat. The targets identified were not military installations or nuclear facilities, but the essential civilian infrastructure that provides electricity to 90 million people. The international community watched in high tension as Iran, which has been in a state of active conflict for 3 weeks, issued a defiant response. They stated clearly that any attack on their power plants would result in a total blockade of the Strait of Hormuz and the systematic destruction of American energy and technology infrastructure throughout the entire region. This exchange represented the opposite of de-escalation, placing 2 nuclear-capable nations on a collision course with a ticking 48-hour clock. The global markets reacted to this ultimatum with immediate and profound alarm. This was not a standard market correction, but a systemic panic driven by the realization that within 2 days, the conflict would either resolve through an opening of the strait or escalate to a level of total war that would dwarf the hostilities of the previous 3 weeks. In such a high-stakes environment, institutional investors moved to dump risk assets simultaneously. No major fund or trading desk wanted to be caught holding volatile positions when that 48-hour countdown hit zero. This geopolitical tension provided the initial spark, but it was the second trigger, the mechanics of forced selling, that truly accelerated the decline. It is vital for the public to understand that gold's 9% drop in a single day was not caused by a failure of the asset itself or a rejection of its status as a safe haven. Instead, the crash was a byproduct of a broader liquidity crisis within the traditional stock market. As equity portfolios across the globe hemorrhaged billions of dollars daily, institutional investors were met with massive margin calls. When a fund faces a margin call, it requires immediate collateral to cover its losses, and in the world of high finance, immediate means within minutes, not days. When an institution needs to raise hundreds of millions of dollars in cash in a 30-minute window, they do not look for the assets that are failing. They look for the assets that are liquid. Gold is the most liquid asset in the world, trading 24 hours a day in every major currency and capable of absorbing massive sell orders without the market freezing. Consequently, gold was sold not because it had lost its fundamental value, but because it was the most valuable and convertible asset in the portfolio. In a desperate scramble for US dollars, institutions used gold as a global ATM. This coordinated forced liquidation overwhelmed every buyer and every historical support level, leading to a vertical drop in price. To put the magnitude of this event into perspective, a 9% decline in the total above-ground gold supply, valued at roughly $15 trillion, wiped out approximately $1.3 trillion in market value in just a few hours. This was not a recalibration of gold's worth based on economic data. It was the result of automated margin software at thousands of firms generating sell orders that no amount of traditional buying could possibly absorb. Silver experienced an even more dramatic percentage-based decline because its market is significantly smaller and more sensitive to volume. While the gold market sees roughly $100 billion in daily turnover, the silver market operates at about 1/10 of that scale, around $10 billion. When the same institutional selling pressure that hit gold was applied to silver, the impact was magnified, driving the metal down from 80 to 61. Critics have been quick to claim that gold has failed as a hedge during this period of falling bombs and rising tensions. But this view ignores the distinction between long-term value and short-term liquidity. We are seeing a repeat of the pattern observed in March 2020 during the onset of the pandemic. At that time, gold crashed alongside stocks as investors scrambled for cash, falling from $1,600 to $1,480. However, once the margin calls were satisfied and the forced selling ended, the market returned its focus to fundamentals like debt and inflation, sending gold to new all-time highs within a year. A similar correction occurred in January 2026, where gold and silver saw sharp declines before recovering as the forced liquidation subsided. The current market behavior suggests we are entering the third iteration of this cycle, where the price is momentarily divorced from reality by the mechanical requirements of the financial system. Part 2. The Federal Reserve Trap and the Liquidity Paradox. The third and perhaps most complex trigger for this historic market downturn lies with the Federal Reserve and its recent policy shifts. As the conflict in the Middle East has escalated, inflation has become an impossible reality to ignore, manifesting in data points that have shocked the financial establishment. With oil prices surging above 170 per barrel, the producer price index coming in at more than double the original forecasts, and the cost of basic goods like vegetables rising by a staggering 49%, the economic landscape has shifted violently. In response to these pressures, the Federal Reserve has concluded that the previously anticipated rate cuts are no longer viable. They have pivoted to a higher-for-longer stance, signaling only a single interest rate cut for 2026 rather than the 3 that the market had originally priced in. This shift in expectations has sent Treasury yields climbing and strengthened the US dollar, creating a significant opportunity cost for those holding gold. From a purely institutional perspective, the math appears simple. Why hold an asset that offers zero yield when government treasuries are providing a guaranteed return of 4% or more? This calculation drove a secondary wave of selling that crashed directly into the existing forced liquidations. However, a closer examination of the Federal Reserve's strategy reveals a profound and dangerous paradox. The central bank is maintaining high interest rates to combat inflation, yet the inflation currently plaguing the economy is being driven by geopolitical factors that are entirely outside the reach of monetary policy. High interest rates do not lower the price of $170 oil, they do not resolve international military conflicts, and they certainly do not reopen the Strait of Hormuz. Instead, the primary effect of these high rates in the current environment is to increase the cost of servicing the government's $39 trillion national debt. Every incremental rate hike adds tens of billions of dollars in annual interest payments that the government must fund. Because these payments are funded by issuing more debt, which in turn requires more currency printing, the very tool the Fed is using to fight inflation is effectively generating more inflation over a longer time horizon. This is the structural trap that characterizes the modern economy. It is a cycle where the central bank risks losing control of the currency. And historically, when central banks lose control, precious metals do not merely stabilize, they tend to move in a parabolic fashion. To grasp the full reality of the current situation, we must move past emotional reactions and look strictly at the data. Gold has now crashed 27% from its high of 5,600, while silver has seen 50% of its value erased from a peak of 121. While these figures are jarring, it is essential to place them in a broader historical context. The average annual return for gold over the last 5 years has remained near 40%. This means the recent 27% crash has only erased about 8 months of market gains. The fundamental drivers that created those gains, specifically the debt levels, persistent inflation, central bank accumulation, and global de-dollarization, remain not only intact but are arguably stronger now than they were 8 months ago. The war has added the pressure of $170 oil and a trapped Federal Reserve to an already bullish environment for hard assets. The price has retreated, but the reasons for owning the asset have intensified. This disconnect is even more pronounced in the silver market. Currently trading at 61, silver presents a mathematical anomaly that defies the crash narrative seen in the headlines. Most mining companies produce silver at a cost of between $12 and $15 per ounce. Even at the current depressed price of 61, these miners are generating between $45 and $50 of pure profit on every ounce they pull from the ground. These are record-breaking margins and massive cash flows. Yet the stock prices of these mining companies have been sold off as if the firms were facing imminent bankruptcy. This represents a total decoupling of mining fundamentals from stock market valuations. At any price above $20, these companies are profitable. At 61, they are exceptionally successful. This gap between the industrial reality of the silver business and the paper price of the metal has reached an unprecedented width. Furthermore, the data from the physical exchanges tells a story that contradicts the panic seen on digital trading screens. In the physical market, supplies are under extreme stress. Registered silver on the COMEX has dropped to 78 million ounces and continues to drain. Silver lease rates are holding firm at 12%, indicating a high demand for immediate physical delivery. In Asia, Shanghai premiums remain in double digits, and China continues to hoard metal aggressively ahead of the April 1st deadline. In just the last week, institutional giants have made significant moves in the physical space, with JP Morgan removing 1.6 million ounces from their vaults and StoneX pulling another 1.2 million. While the paper market is screaming that a crash is underway, the physical market is screaming that a shortage is imminent. History has shown that when the paper market and the physical market disagree, the physical reality eventually dictates the long-term price. What we are witnessing is a sophisticated shakeout. The paper market is being used to trigger the stop losses and margin calls of retail investors, the minnows who lack the capital to survive a 9% daily drop. As these smaller players are forced to liquidate, the whales, sovereign wealth funds, central banks, and family offices, are moving in to absorb that physical metal at a discount. These large-scale players operate on generational time horizons rather than 48-hour clocks. When a whale looks at the current landscape, they see a national debt growing by $1 trillion every 100 days, oil prices driving inflation that the Fed cannot stop, and a 27% discount on the ultimate hedge against currency failure. To them, this is not a crisis. It is a gift provided by the mechanical failures of the leveraged trading system. They are buying quietly and in massive size while the public is being driven by headlines of fear. This is a well-documented pattern in financial history. It is the mechanism by which assets are transferred from weak hands to strong hands. We saw it during the COVID-19 crash of 2020, we saw it during the 2008 financial crisis, and it was a hallmark of the gold market corrections in the 1970s. The tactics remain the same even as the numbers get larger. Every ounce of gold sold in a panic at 4,100 is an ounce being purchased by an institution that understands the long-term debt trajectory of the global economy. Every ounce of silver liquidated at 61 is being moved into the vaults of those who recognize that the industrial and monetary demand for the metal has not changed. The crash is simply the tool used to facilitate this massive transfer of wealth at the lowest possible price point. The question facing every investor tonight is whether they will be the one providing the liquidity at these discounted prices or the one recognizing the pattern. As the 48-hour ultimatum nears its conclusion, the volatility is expected to continue. We are monitoring the order books and the vault drains closely to see how much more physical metal is being moved behind the scenes. The institutional players who helped create the conditions for this panic are now the primary beneficiaries of the selling it has generated.